Hi guys, I'm Phil Town for Rule 1 Investing, and today what we're going to talk about are indexes and investing. So indexes are a stack of companies that are chosen that best represent the very large indexes. Now, indexes are kind of a surrogate for how the market is doing. And the major ones are the Dow Jones Industrial Average, which is 30 industrial sized stocks, the S&P 500, which is 500 largest stocks out there, and the NASDAQ, which is the tech stocks, about 100 tech stocks. Now, in addition to that, there's the Russell, which is typically thought of the Russell 2000. It's about 2,000 stocks that are small capitalization stocks, ranging from 250 million to about $1 billion. So it kind of follows stocks that are a little more volatile. Now, the biggest index of all is called the Wilshire 5000. And this is the one that is covering 4,000 some stocks. Used to be 5,000, but there's no longer 5,000 public companies that can follow because of the changes in regulations, kind of keeping companies from going public. So why do we think about indexes? Well, the first reason to think about them is because Warren Buffett says, look, if you're not going to learn how to invest properly, then you should invest in indexes. Right? So buy the Dow, buy the S&P 500 indexes, and buy the Russell index and the NASDAQ. Now, how would you do that if you're going to follow Buffett's advice? Well, what you would do is you would buy stocks that are created to follow these indexes as closely as they can. These are index exchange traded funds. They are companies or stocks like the Russell, RUT, which is the index itself, is followed by IWM, which is the Russell index stock. The S&P 500 is tracked by SPY or spiders. The Dow Jones Industrial Average is tracked by DIA or diamonds, and the NASDAQ is tracked by the QQQ. So these are all stocks which you can buy out there, very low fees, and they track the indexes. And really, if you're not going to learn how to invest, and you have a choice between putting your money in a mutual fund that's based on the index, something large like Fidelity Magellan, say, or just buying the S&P 500, you're going to save yourself a lot of money just by buying the S&P 500. So I'm going to recommend to you that we go a little deeper into index investing than just the idea that if you're not going to learn to invest, then just buy the index. There's a problem brewing that several very successful investors have brought up to the companies that are creating these indexes. What they've said is that as more and more people buy the index stocks, which in turn buy the index stocks individually in order to match the index, there are less and less people who are out discovering what the real price should be of those stocks. In other words, before anybody had an index, the stock prices were all just a negotiated price based on somebody that thought it was too high and somebody thought it was too low. That's called price discovery in Wall Street jargon. And price discovery is pretty fundamental to getting close to the market, finding the right price for the right value. Now, we know as a Rule 1 investor that price and value are not the same thing, that the price can be higher than the value or lower than the value. And in fact, over the long run, those changes in price can ultimately kind of follow the value of the company. A long time ago, Ben Graham, who started this whole kind of investing called value investing, which we call Rule 1 investing, Ben Graham started it with the comment that the market in the short run is a voting machine. It's all about emotion, who's the most afraid, who's the greediest. But in the long run, it's a weighing machine. It is going to find the right price for the right value of these companies. So the problem with more and more people investing in indexes is there's fewer and fewer individual investors who are actually seeking the true value of the company. Now think about what that means. At some point, the majority of the money in the stock market, if we all follow that advice to just invest in indexes, at some point, all of the stock prices are only reflecting the fact that everyone's buying the index. In other words, there's no relationship any longer to price and value. Now, this could become a really horrendous situation if you're investing in indexes. Why? Because the possibility is, or the probability would be at that point in time, that any big change to the, let's say, economy on some sort of macro level, a war starts, There's a shakeup in U.S. industries. There's a different administration that comes in with taxation. We have a terrorist attack on the White House. Something that really rattles people, something that creates a lot of fear and makes people concerned with their money for their retirement. If they start pulling that out, the only thing that can happen with indexes is the index sells off those stocks. It has to, which makes the index go down, right? So the index fund sells the stocks, the index goes down, which scares more people, which causes them to sell their index fund, which has to sell the stocks in the index, which makes the index go down farther. And you can see this sort of terrible cycle could start a plummeting market. And when that market starts to plummet, it can accelerate the fear. And with more fear, there's more selling. And the next thing you know, we have 1929, which is exactly what happened. The market started getting sold off, people got very afraid, and the market went down 90%, okay? Now, what we're looking at with indexes is an opportunity if you happen to be a Rule 1 style investor. Rule 1 investing, the kind of investing we do, the kind of investing Buffett does, depends to a certain degree on fear and greed. It depends on volatility, that the market is going to misprice individual stocks far too high, in which case we become a seller, or far too low, in which case we become a buyer. So, should we really try to change the rules that say that, you don't want too much of a percentage of the market being invested by index funds? If you're a Rule 1 investor, you say, no, we shouldn't try to change those rules at all. We should let those guys go. We should encourage them to do it. Maybe that's behind, Buffett's comments that if you don't know what you're doing, buy the index. I hate to think that he's that cynical, but I'd be willing to be a little bit cynical about that and say, hey, go buy the index because it's going to make me and all of our students rich when you start creating a market that is no longer based on values at all. So if you're interested about this kind of discussion, how about thinking about this question? Have you ever done any investing with index funds, exchange traded funds? And are you at all nervous to know that about 30% of the market is now just indexes? Leave a comment below with your answer, and I'll be sure to follow up with you. Thanks for watching. Now go play. Hey, if you enjoyed this video and you feel it was valuable for teaching you more about the dangers of investing in indexes, hit the like button and please share this video with your friends. And if you want more investing content, just subscribe to my channel. And don't forget to click the button on the screen for a free gift. Thanks again for watching.